análisis y en este caso pasamos a la mirada internacional con Jean-François Robin, es Global Head de Natixis CIB Research. Jean-François, thank you so much for having us a few minutes.
Hello, thank you for inviting me.
In regarding to the energy crisis in Europe, do you think a recession is unavoidable?
Well, we think it's going to be more a stagnation more than a true big recession like we had in 2008, for instance. It's more a big slowing down of major economies. Europe will come from 3% GDP growth to 0.5, something like that. So it's more stagnation in a sense that at the end of 2023, we will be above the end of 2022. So this is not a big recession. Having said that, every OECD country, every European country is going to experience a major deceleration. But it's the case of the United States as well. America is going to slow down massively from 1.8 to something like 0.6. So you can see that, in fact, Europe did better than the US this year and probably will do a little bit less than the US, but not that much. So this is a big deceleration of the world economy. The only exception being these days China, because it's reopening. But let's see if it can continue. But clearly, 2023 is a big, massive deceleration. 2022, at the end of the day, was a very good year. I think of Spain or Italy, almost 4% GDP growth. France will be around 2.5, 2.6. Europe around 3%. So this is a massive deceleration from quite a decent, nice 2022. But 2023, not a big recession, a stagnation in our view.
So a stagnation, not recession. Meanwhile, we are looking at China and its exit process or relaxation of its zero COVID policy. Regarding to 2023, what's your point of view about China? Will China's economy rebound this next year?
Well, we were almost the most negative on China this year. We were slightly below 3% expected this year from China because the zero COVID policy plus the big trouble out of the real estate market. We know that it's almost 30% and 1/3 of Chinese economy linked to the real estate, and it was nowhere. It was close to zero. So very big problems of China. So we had to totally change the policy here. So we are turning for next year as probably one of the most optimistic regarding China next year. We expect 5.5 GDP growth, which is a big surprise, and this U-turn from Xi Jinping, and it takes a little bit more of consumption, investment, tourism to see a Chinese economy to be above 5% next year. And this is important because it means one of the three big engines of world GDP is going to restart next year. So Europe, US, close to zero before rebounding probably in 2024, but next year close to zero, as opposed to China, which is going to restart. So a bit on total contrary to what happened to the other countries. And if China does 5.5 GDP growth around, probably it means that Hong Kong, Singapore, think of Thailand, probably they will be growing by close to 10%. So the Southeast Asia will be growing fast next year. So this is a very good news for the world trade and world GDP. This is probably a bit bad news for the energy crisis in Europe because it means that China was nowhere when it was when it comes to gas imports, for instance, last year or this year, 2022. Next year probably will be a bit more. We will get some more competition from China to get some gas out of a country like Qatar for LNG, for instance. So good news for the world economy, maybe a little bit more complex for the energy situation in Europe.
And if we talk about markets and asset allocation, is it better to buy the dip or on the rebound?
Well, we are on the cautious side regarding markets. Like I said, if China rebounds, probably it's good for emerging economies. If we see that's good for emerging at some stage. But if we look at a risky asset like a stock market, it's a little bit puzzling to see this big rebound that we have seen in October, November. We are close to having stocks over the year, 2022 close to be flat. So that's a little bit surprising. We are still experiencing a major slowdown. I was mentioning it. We are still seeing some big increase in prices. So the input prices for corporates are going up. Wages are going up all over the world a bit more than previously. So this is compressing margin from companies. So it means that the expected returns for stocks are going to be lowered at some stage. So we are thinking that it's better to wait before we start to see the end of central banks hiking rates. So probably after the end of the first or second quarter of next year, that will be a much more rosy scenario with inflation going down, central banks stopping hiking rates, and we will start to see that 2024 will see a rebound, probably close to 2% in the US, 1.5, 1.8% in Europe. China has said it, 5.5 next year, probably 4.5 in 2024. So it's a bit of not a V shape, but clearly end of first quarter will be a good entry point for risky asset, including bonds first and then stocks.
And we talk about real estate, which is the evolution that you are seeing right now about this sector. Can we expect a revaluation of real estate assets or a decline in prices?
Probably a decline. If you think of it, the economy is going to slow down. You have increased interest rates. It's clearly the case in the US. Probably we are close to the end of the hiking cycle by the Fed, but still we have seen that when the mortgage rate in the US went up above 7%, in a way, in the US for the 30 years the mortgage rate, we have seen that the credit loans for real estate in the US was down 70%. We start to see housing starts declining like never before. Last time we have seen that it was in the 80s. We see that house prices in city like San Francisco is down 10%. So we see that the interest rate is weighting very much on real estate. Think of New Zealand. We can now see some prices down by 20%. We see that in the Nordic countries. So when you have some variable rates, it's very, very negative for the real estate. So slowing down of economy, rising rates, probably a little bit of unemployment rising in the US, maybe up to 5.5%. In Europe, probably up by 1.5%. Maybe not more than that, because we see that the labor market is very constrained still, but it's going to be less positive in a way going forward. So we are very cautious on the real estate market globally. It's a bit different between logistic or between household or retail, but it's globally a negative environment for real estate.
Inflation will be, of course, an uncertainty in 2023. It will be one of the main subjects this new year, as it has been in 2022. Is the US and European economic slowdown leading to peak inflation?
Yes, that's a very good point. If we have a deceleration of economy, inflation is going to decelerate. Obviously, when demand is going down, prices are going down. Think of wages as well. If you have some deceleration of the economy, rising unemployment, then wage negotiations are going to be probably less positive next year compared to this year. So inflation is going down. But more than anything else, what matters for inflation going forward is the energy prices. And when we look at energy prices today, and when we are going to look next March on energy prices compared to last March 2022, when Russia decided to invade Ukraine, we have seen oil prices, gas prices, all the commodity prices, wheat prices going up massively. But when we are going to compare the level of inflation in March next year to March this year, we are going to see a massive basis effect. And think of gas prices. They went up to 340 euro the megawatt hour for the TTF gas, We are today at 102. So we have been divided gas prices by 3. Think of oil; it went up to 140, and as we speak, it's closer to $80. So we are going to see a massive deceleration of energy prices. So probably it's fair to say that the peak of energy crisis is behind us. It's not to say it's going to be simple to move from Russian gas and oil and coal to full renewable electricity or to some sort of nuclear, especially for France. But still, the bulk, the peak of the energy crisis is probably, as for inflation, behind us.
And finally, if we talk about European banks, we can say they are navigating between rising rate environment and threats, of course. What do you think? What are you waiting for? Because we have seen how the ECB is warning about banks for next year, for 2023.
Well, our analysts are quite positive for banks. Maybe surprisingly, you said it. When you have a rising, you have a deceleration of economy. You have a central bank which is taking back a lot of excess money. ECB was very generous in providing money to the economy through banks, and what we have seen already in November and in December is that ECB is going to take back much faster its liquidity from the banking system compared to the US, and probably maybe twice faster in Europe than in the US next year. So a lot of money is taken back, but the big effect for banks is probably the rising rate environment. So overall, with some banks having done a lot of provision, my analysts are quite confident that at the end of the day, the net effect is quite positive for European banks. They are much more solid than during the great financial crisis of 2008. They have done a lot of provision, and the net margin of interest is going to compensate for the withdrawal of supply of money by the ECB. So overall, this environment of rising rates is quite positive for the banks. The rising rates are good for banks. The only thing is that the shape of the curve, if you want to go a little bit more into details, there again, probably the second part, at least, of 2023 will be more positive, because we will see a bit of a re-steepening of yield curve, which is already at play probably in the US, or is going to be earlier on at play in the US. So this is not that bad environment for banks, contrary to lots of opinions. Rising rates is a good news for the banking system overall, which is much more safer, healthier than it was during the 2008 crisis.
Jean-François Robin, Global Head of Natixis, thank you very much. It's been a pleasure.
Thank you very much for inviting me.
Nos quedamos, por tanto, con